Well, thank you very much for this opportunity. As I said to you, in our project on the future of the global financial system, one of the areas where we really want to go into more depth is the global financial system from the standpoint of the perspective of developing countries and the needs of developing countries and the opportunities that exist there. So I would like to ask you to begin with, since you cover the developing world, how do you, in your mind, how do you categorize the developing world in terms of, different groups of countries? I'm just looking for a conceptual roadmap, which may be in your head, of when you think about global finance, what are the different groups that you have to focus on?
Well, I think thinking of the developing world in groups is the right thing to approach the many and different countries with. During the last 15 years or so, I've been seeing better, in a better way, aspects related to how to categorize countries, not just based on their per capita income, as we used to do in the past, but based on other considerations, for some of them to be resource rich, for instance. So they might be low-income countries today, but they have decent potential if they can manage to use their natural resources in a good way. There are countries with problems of demography and population issues. There are problems as far as countries with access, like landlocked countries. Countries which could be considered with problems of fragility or being post-conflict. So I like really to approach the developing countries. I know that there had been this kind of distinction between low-income countries and middle-income countries. And within the middle-income countries, you would have one or two or three categories or filters based on income. So in addition to the income perspective and the per capita income, I would add some specific other filters to help us understanding the potential needs of countries based on a kind of a dynamic perspective. Resource-rich or resource-poor is one of them. Landlocked or with access is another. The issues related to fragility and matters related to demography and population growth. This could really be an additional filters. They may complicate the map a bit, but when it comes to the engagement at the country level or at sub-regional level, they would be very much helpful in understanding the best mix of financial solutions that could be available from the countries or from the international community. And on the international community, whether that could be based on concessional terms like the overseas development assistance, or through portfolio investment or foreign direct investment, or borrowing from markets.
Okay. It's a very complex situation, and so some of the questions I'm going to ask you will necessarily be oversimplified, but let me start with this notion and tell me whether it's right. Many advanced countries have the philosophy that if the global economy, the global financial system as it's now constituted, if it works well, everybody benefits. And in fact, the major requirement is smooth capital flows, liberal, open global economy with regard to finance and trade, and that this is the basic need. But from the standpoint of developing countries, if you believe that philosophy, you would basically say that the structure is sound and that the governance is sound. So I'm going to ask you to put yourself on the other side of the table, in a sense. You're not, let's say you're not a highly developed country. Is this philosophy adequate? In other words, if the core works, everything else works, or is this just the first step?
This is very much the first step, and this could be, I would say, an essential prerequisite for countries to get engaged in, to have a kind of a well-functioning global financial system. But it's all about the details and how to describe well, about ease of access, lower transaction costs, hopefully lower volatility, and for the countries to be engaged, to be with the adequate governance and the adequate financial system to make them able to tap into these resources, and to have as well the adequate fiscal and monetary policies and foreign exchange arrangement that would allow them to minimize the hassle and the trouble of such engagement. There is no theory about that, but I think one really could be borrowing from recent history and evidence from countries. I was part of this team led by Professor Mike Spence on the growth perspective and the inclusive growth, and we have seen how many countries managed to do well because of better arrangements for them in a benign global and regional environment that allowed them to enhance their growth, and in a very inclusive way. So for countries, I think the number of those countries were around 13 of them, ranging from smaller countries like Singapore to big countries like China. Many of these countries happen to be in the south east of Asia, but others like Brazil managed to do well as well in better dealing with the capital flows. But here there have been many other conditions, and I would say rather than a recipe, there have been ingredients for such an engagement. So there had been some decent macroeconomic stability in all of these countries. There had been some good and sound political stability, regardless of the kind of a political regime, be it democratic or not, but there had been some sort of stability. There had been some sort of forward-looking in their way of planning for the future, including saving policies and investment policies. There have been some investments in infrastructure and human development, and there had been finally some good work on reliance on market forces, but with effective regulations. So that would confirm really this assumption that yes, it's very much needed to have a global financial system, and I bet if the global financial system was not conducive, supportive to these countries like China, Singapore, Korea, Japan before them, Brazil in their high growth years, they wouldn't have managed to achieve what they achieved, or they would have achieved it but with a bit of lag or a bit of delay.
So I think what you're saying is that if you had a smoothly functioning global financial system, one of the next requirements is sort of the domestic set of policies within these countries that allows them to tap in. I'll put it another way. What I don't think you're saying, but I'm posing this as a question, is that from structurally, developing countries don't need something different than currently exists. The structural issues are more internal issues. Would I have that right?
Yeah, very much so.
Okay.
Very much so. I know in many cases, especially in the times of trouble, you would find many people and many policymakers would really find a good justification for some problems by assuming that there are some external factors behind their internal trouble. There could be many countries, and we have seen it recently because of crises of different nature during the last 7 years or so, a food crisis, fuel crisis, financial crisis. Yes, there were some important developments in a negative way with shocks to the internal systems. But again, even with these external shocks, different countries adapted differently and managed to accommodate these problems based on their efforts at home to deal with these big problems. For some of them, it was basically a small hiccup. For others, it was like a flu. But definitely developing countries managed to do better than the advanced economies because many of them were already subject to many of their internal reform that helped them dealing with these crises. Of course, they suffered, but they would have suffered more if the internal reforms were not in place.
Okay. So I'm going to ask you now about a series of sort of policy issues, and maybe you could just comment on them.
Sure.
The first has to do with the importance of the development of local capital markets or domestic capital markets. Can you explain a little bit, when you go to these countries, when you advise them, can you summarize what the agenda is for developing vibrant local markets?
Well, it's very important and it's very essential. And if countries, as we see them, developing countries and many of the advanced economies as well, are suffering, say, from one particular issue related to infrastructure, and infrastructure investments in many cases may require domestic finance in local currency, not to be exposed to the foreign exchange volatility. And what we have seen that many countries which did better than others are basically the ability to finance that at least partially or significantly in many cases from domestic resources. That comes from two different sources, either from government finance, and especially the countries that were basically lucky with the natural resources and benefiting from the increase in the commodity prices. They had some sort of decent budget revenues that enabled them to spend on infrastructure development. But as you know, not all of countries are enjoying such a position or enjoying balance or budgets with surplus. So they would rely on markets in different ways, on public-private partnerships or in private finance. So if you don't really have adequate capital market with its all component, with a good banking system that is very much essential even for infrastructure, at least in the initial phase, and then you need to have a local currency, bond market or a fixed income market based on local currency. Here we have seen that the development of the capital market in many emerging markets and developing countries have been very much in the equity side rather than on the long-term fixed income side, for many reasons, including the role of government as a major borrower in these countries, including lack of interest to develop a secondary market, including issues related to technology or institutional aspects or legal reforms needed in order to improve the local currency market. There have been many initiatives. Many of them have been associated recently with the G20, not just with the advanced economies or the advanced members of their economies and the G20 sponsoring them, but many of the emerging markets as well as partners. In the World Bank here we have a couple of initiatives with the IFC and the World Bank side as well on enhancing the capacity of the local currency markets. It takes time, it takes lots of investment in the infrastructure, and it needs as well a kind of pipeline for possible issuance and issues related as well to the settlement and clearance of the transactions that would require more than normal kind of coordination between treasury in these countries, central banks, and the capital markets and the institutional investors. We have been seeing some sort of progress because of the benefits, but the progress is not really as fast as one would wish.
Okay, that's great. Let me ask you another category. There's a lot of urbanization going on in developing countries. How do you think about finance, or let's say the requirements for finance when it comes to urbanization? What is the link between the financial instruments that are needed and the requirements that big cities naturally throw up?
The bank has finished some good knowledge reports on matters related to urbanization, including a very recent one for China. But our engagements are not just with the larger economies like the Chinese one, but with many of the low-income and the middle-income countries. And we're aware of the development and the importance of cities and the size of population that are being hosted today in urbanized areas. Some of them are not really as formally as one would wish to be called urbanized, because many of the plans were not in place, many of the investments were not adequate, and there have been a great deal of informality when you have these kind of cities growing or mushrooming without decent planning, without vision, and then in many cases you'll have these towns and cities growing, and then you try to catch up with a bit of greening of their urban development or a bit of infrastructure support, including the essentials like electricity or sewage networks and the likes. Here I think the matter for countries that could afford it, I would say for the Arab Gulf countries, they can afford having these plans and fully funded from their own budget without much of reliance on the private sector, unless in matters related to contracting them and in the construction phase. But in many other countries, the mix of finance from government money and the private sector, including the household contribution, because many of these kind of urban developments end up to be for residential areas, not just for commercial or for industrial zones. So we need here to mobilize all possible sources of finance. If you identify them as follows, you have the government finance as one source, you have the private sector with a bit of inclusiveness assumed in their way to get engaged, because not all of the private sector members, if you include the corporate side or the household side, will be coming with ready savings of hundreds of thousands or millions. So this would really assume some sort of capacity to penetrate the capital market at home or domestically to help them engage in this kind of urban development. There is the third aspect related to the international finance, the non-concessional side of it, if you can consider, and this is happening very much, on the role of FDI through PPPs or otherwise to establish infrastructure projects there, including to support the urbanization, including in projects in energy or in water and sanitation. And the fourth, for the low-income countries in particular, related to the concessional finance of overseas development assistance or long-term finance that could come from institutions like ours or the regional development banks. So the issue here for the planner, having the proper vision, having the plan, and how to mobilize the four sources of finance in the proper mix based on the country initial conditions. For some countries, ODA may not be that important because of their conditions. In some other countries, like typically many of the members of the sub-Saharan Africa, would be more of beneficiaries of ODA.
Okay. So the third category I'm going to talk about, I'm just going to put in the arena of alternative finance, and I'm saying that because it's alternative vis-a-vis, say, the United States. But I'm thinking about microfinancing, mobile money, crowdfunding. The question I want to ask you is it the case that in many developing countries we are seeing the development or the evolution of financing techniques that are not very prevalent in the developed world, but very well could constitute over time a whole other arena of finance, beyond the conventional fixed income and equity and all the stuff that we're familiar with, that there is actually evolving financial techniques and financial instruments that carried to their logical conclusion, will constitute a very significant part of the global financial system. Now, I say that with much more confidence than I know, but I'm just wondering if you would comment on that.
Right, you gave some examples, and let me add to the examples of alternative finance based on what we have been seeing in different communities and different countries. And some of these means of finance or financial solutions may not really be that significant yet, but they are trying to establish themselves in their own communities, providing solutions and creating some sort of a niche. And in many cases, they may not really be considered necessarily as substitute, but complementing the conventional financial instruments in more than one way. Some of them are as old as the cooperatives, and I'm seeing a revival of cooperatives and cooperative finance in many communities. Traditionally, they have been in the agricultural sector, but they have been seeing them extended to other sectors as well, including commerce, trade, housing arrangements based on the cooperative solutions. And as you know, the model is very much different. There are elements of enhancing revenue for the members of the cooperatives without really getting too much into pure profit maximization and distributing the profit as such. But they have to make the profits, they have to enhance revenue, they have to control the spending, and they have to be efficient. And there are some goals that had been getting all of these communities or members of cooperatives together. And these models, they are not very much alien to the American economy. They have been here, and some of them do exist. Canada could be more of a beneficiary for many of the cooperative solutions. Germany financed many of its small and medium-sized activities and firms based on these solutions. The other one, I would say, the Islamic finance versions. This is a market today of around $1.4 trillion. So it's of significance if you relate it to some economies. If you relate it to the global economy, it could be cruising between 1 to 2% of global finance. But if you relate it to the market that they are operating in, like Malaysia, which has something like a quarter of its banking system claiming to be working according to the Islamic principles or Islamic finance framework. We have seen a rising role for some countries in the Arab Gulf countries or in Turkey, have seen some activities in Europe, Luxembourg, London, and Paris change their regulatory framework to allow for some transactions based on Islamic finance, including the sukuk, which is basically the long-term finance version or the equivalent of long-term fixed income or bonds. So I would identify cooperatives and Islamic finance as providing alternatives, and they're becoming very much sophisticated in their solutions. You mentioned some other solutions based on technology, on access. One is very much impressed when I see what's happening today in some sub-Saharan African countries, like the work of Kenya with their access to finance based on mobile phones and their technology in the transfer of transactions within the country. And I understand as well that there are some cross-border solutions that are being provided for to lower the cost of the remittances between different countries. And here I think the old world and the new world need to get together, and the conventional finance and the alternative finance need to get together in two aspects. First, on the regulatory framework. Whatever is going to be there innovated, they have to be subject to some sort of standards and rules of engagement, not to violate the system. And again, rules related to the literacy of finance, consumer protection, concerns about possible systemic risk, with particular definitions in the smaller countries. I know that the world and the G20 have been very much focusing on systemic risk when it comes to bigger financial institutions affecting larger economies. But these smaller countries as well could be exposed to serious systemic risk if they are not really putting the house in order. So financial literacy, financial regulations, and issues related to consumer protection as well need to be there, whether under Islamic finance solutions or cooperative finance, or you use your mobile rather than your bank to transfer the funds. These kind of conventional wisdom by now, you don't need to reinvent wheels. We encourage innovation in finance. We encourage people to go and challenge the traditional system or even challenge the alternative to the traditional solutions, but you don't really need to reinvent wheels when it comes to the rules of engagement. Do whatever you like, but adhere to the rules. Effective regulations, competition, consumer protection, and make sure that those who are engaged in the industry know what they are about. And here the issue of financial literacy, as you know, is not just an issue for the developing countries and emerging markets. Well before he got his Nobel Prize, I was one of the admirers of Professor Schiller because of his emphasis on these issues related to financial education and financial literacy. His advice back in 2007, 2008 on how to deal with the mortgage finance crisis in the United States, his small booklet on that, I think 50% of it was basically on issues related to financial literacy and the infrastructure that you need to establish in order to get people acquainted with what they should know when they are getting engaged with finance, either in instruments or in institutions or new products.
So this may be an unfair question, but this what you're talking about sounds to me like a gargantuan challenge. It's a challenge in the U.S., but when I think about the difficulty of, first of all, devising regulations for new kinds of financial instruments or techniques, for example, in the U.S., let's say, you know, the very rapid flash trading that has the governments tied up in knots. How, from the World Bank standpoint, do you think, or do you size up the challenge? Let's just take financial literacy in most of the developing countries. Are we talking about a 2-decade effort? Or are we talking about something that is much more doable than I seem to think?
Well, I think it's very much in between. It is not a 2-decade issue. And it is not really an easy thing to do, like switching on or off your electricity. So it takes a while. It needs infrastructure. It needs patience. It needs different approaches to the matters. And one of our main pieces of work on the knowledge and on the technical assistance is basically how to get the regulators and those who are involved in the consumer protection in the finance industry in developing and emerging markets acquainted with the new rules like Basel III or the implications of the Dodd-Frank or some interpretations of them. There is a particular lag, and this lag even perceived here from the day that these laws and regulations are coming out until they are being interpreted, until they are being applied, until you have a couple of accidents for everybody to know more about them by learning by doing or learning by not doing. So in the case of the developing countries, the advantages are as follows. They are with smaller economies and with smaller challenges than the bigger countries. The other thing is basically they have the advantage of starting late. So sometimes they may just take it from where you left it. And that's why the issues related to use of the technology, I'm very much amazed and impressed when I go to many African countries or to South Asia or to Eastern Europe and I see more sophisticated solutions with adequate information available to them to their clients compared to your typical consumer of financial service, say in New York or in London, because these guys are benefiting from this simple advantage of starting late in their way of getting things done. The other thing is basically about the aspect of financial inclusion. While you see many people with bank accounts and access to finance in countries like the US or Canada or Europe or Australia or New Zealand, the financial access in many developing and even emerging markets is still not really reaching the levels that you like. So while you are improving the access to finance, you can gradually support the system that will make everybody aware of rights and implications. And the other thing is basically the emphasis of the past, either with the education facilities or by the regulators, was with very much training of regulators, central bankers, and financial services authorities, and leaving the consumers, who are the majority, behind and not very much attended to. Now I think there is much more effort being undertaken in this front. It takes two for progress and takes two as well for crises like the one that we have seen. So using some sort of inputs to curriculum for schools and universities, we are seeing it very much widespread, and we are very much engaged with many countries in providing such inputs in their curriculum. The other thing is what we call here entertainment education. So to what extent you can use some popular soap operas or movies to insert a couple of pieces of advice on how to deal with the financial system. And we have been very much involved. I think our recent report, the Global Financial Development Report, had provided many cases in Latin America and in Africa and in Asia as well, and in the Middle East, in using soap operas which have been not very much used for such purpose, or social media, including Twitter and Facebook, on making people more aware of the opportunities and enhancing competition as well.
So my final question, I mean, I could talk to you all day, but the final question has to do with the post-2015 development goals, the development agenda. And I'm wondering if you could just summarize the philosophy that kind of surrounds the effort to develop a whole new set of goals, and where you feel the financial system fits in.
Well, thank you so much for the offer to talk more. And in this particular topic, I can talk until the end of 2015, until we start embarking on January 2016 to implement the new phase of development goals. As you know, currently we are with the MDGs phase that started in 2000, and it should end on the 31st of December 2015. Now the UN system is leading the work on drafting the priorities for the world from 2015 to 2030. And it's very much an inclusive process. It's not like in the past what was made in the 1990s. It was a different world then, when some wise people from the advanced economies set the priorities of the South. Now it's very much an inclusive and engaging process for all of the members of the UN. So I think the timetable is as follows: that by the time of the General Assembly in September 2014, there will be some reports submitted based on technical and political discussions and getting opinion from think tanks, from organizations, international organizations included, about the priorities for the future. Many of the goals are similar to the ones that we have today, like eradication of poverty or education or health, but with more of a quality dimension attached to them. There is more concern about the climate and the climate change and the environment. We are learning from 15 years of doing or less than 15 years now on the MDGs, so there have been some inputs on these goals. It's very early to say whether that we're going to be having 8 goals like the one that we had today, or what we have today, or 10 or 15, or more or less, how many targets and indicators are going to be attached to them. But these goals are going to be tackled from 2 levels at least. One of them is global, because there are many global public goods or global public challenges, as Professor Larry Summers like to call them. They are challenges until you find the solutions of finance and implementation to them, including issues related to environment, to climate change, and health and communicable disease. There are issues that you may need to tackle, and there are the majority of them at the country level. So for the global level, you need global resources. You need some sort of global financial support for institutions and mechanisms that are providing solutions and help as far as the global public goods are concerned. But for the countries, you need really, and going back to the point we shared earlier together on these issues of the sources of finance, how to mobilize effectively your domestic resources with the domestic private sector, with the international finance, and with the overseas development assistance with adequate innovation in order to provide the best mix of finance, to provide the kind of funding needed to eliminate poverty by 2030, and to enhance access to education, but with higher quality, because, as you know, the education targets of the current goals are only about enrollment and the averages. They are not really very much concerned if a person is getting decent education in Yale University or a university that doesn't really provide necessarily quality education. So there is going to be a quality dimension to that, on health, on infrastructure, on inclusive growth, on job opportunities. There are going to be goals. All of these goals are about three things. To what extent we know what we are talking about, so what kind of data that we need, and the call for a data revolution is very much in place there, because we need better data to know what we are after of targets and goals. The second is about the finance for all of the four sources I just shared with you. And in addition to that, you may know the information, you may have the money, but you may not really have the know-how and the technical expertise to implement and to reach the goals. So, and here comes an institution like the bank, that we can really be helpful in building up data infrastructure and avail the information, not just to collect the data and keep them in closed archives, not accessible to anybody. And second is basically how to provide finance. We know now that our finance, along with others, is a fraction of the private finance. So the issues related to leveraging private finance and getting into partnership is very important. And to identify to ministers of finance and to development ministers the means and way that they can really do a better job in mobilization of funds, be that government or private funds, to achieve the goals. And finally, having this kind of know-how in specific projects and sectors, and to provide the best knowledge that we have to provide solutions for development. So this is basically what we are trying to do now, and to get prepared for the big day of starting the sustainable goals comes 2016.
Well, that was wonderful. That was very, very clear, and it was very integrated, and exactly why I wanted to talk to you. Thank you so much. It was really
Thank you so much.
It was a great education. Thank you.
Thank you so much, and thank you for giving me this opportunity.